Hi guys, it's Ted here. Let's get started. So, comprehensive quantitative finance, statistic and metrics. So, this notebook will be covering 25 essential statistics and metrics used in quantitative finance, evaluating models, strategies, portfolios, and algorithm. And I will tell you the formulas behind it. What does that phrase mean, like Sharpe, Kalmer, skew, kurtosis, and what is a good value or a good range to have for that specific metric to know that your model or your portfolio is doing fine or doing good or doing really good, right? Now, let's start with return based metrics. So, the first is cumulative return. The meaning is the overall aggregated return over the entire backtest or investment period. So let's say your backtest is from 2016 to 2026. So it's a 10-year period, right? It shows total growth of an investment without considering the time it took to achieve it. So the growth is always compounded, and the growth could be 200%, 300%, 50%, 100%. So for cumulative return, I would suggest that you always use logarithmic scale. Why? Because let me give you an example. So basically, if you are using basic cumulative return based on percentages, right? So for a percentage, let's say I will write it down here. So let's say, see the screen. If a stock goes up 10%, right? And then it goes down. Where did it go? So if a stock, let's assume the stock price is $10, right? And it goes up by 10%. Now it is $11, right? And then it goes down again 10%. All right. Now, in reality, with using percentages, this will be reduced by 1.1 dollars, right? Because the fall is in percentage terms is more. So something could go up infinitely up, but anything can go down only by 100%, right? That is also another reason why shorts don't work in live markets. So now the stock is at 9.9%. You're actually making loss, right? But as per percentages, you are at net 0%. This is where logarithmic scale comes in, and it will show you that you are in a loss, right? Now I will rerun this. Yeah, so this is cumulative returns versus the benchmark graph. Now let's talk about CAGR is what, if you are new to finance, it's compounded annual growth rate, the geometrical progression ratio that provides a constant rate of return over the period. It annualizes the total return, so strategies with different time horizons that can be compared. Formula is ending value divided by beginning value up raised to the power of 1 divided by s minus 1. A good range is 10 to 20% for solid long equity strategies. Above 20% is excellent. 30% over a long period is elite, but often hard to sustain at scale without leverage. Now, let's see. This is a example of CAGR 17.6%. You can see the smooth path and the actual growth. Now, let's talk about annualized volatility. What is annualized volatility? It means a statistical measure of the dispersion of returns. It represents the standard deviation of returns scaled up to an annual time frame. So, volatility coefficient of annual is equal to standard deviation of daily into square root of 252. Why 252? Because 252 are the number of trading days. Now, good range is less than 15% is considered low to moderate risk, because of SP 500 has a analyzed drawdown of 15 to 18%. Above 25% is considered highly volatile. Now, this is a 30-day rolling annualized volatility graph. Now, let's come to risk adjusted performance, Sharpe ratio. Now, what is Sharpe ratio? It measures the performance of an investment compared to a risk-free asset. The risk-free assets are considered the asset not with zero risk, but the least risk, like treasury bills, bonds, right? It indicates how much excess return you receive for the extra volatility you endure. The formula is R of P minus risk-free rate divided of standard deviation of the portfolio, right? Now, good range above 1, Sharpe ratio is good. 1 above 1.5, it's very good. Above 2 is outstanding, right? Now, this is the daily distribution return. This is a Gaussian bell curve, and this is the foundation for Sharpe. Now, talking about Sortino ratio, a variation of Sharpe ratio that only penalizes downside volatility. It does not penalize upside volatility because which is good because you're making returns in that upside volatility, right? But in downside volatility, you're not making any returns until and unless your model is long and short both. Now, the formula for this is again RP minus RF divided by standard deviation of negative returns, not the entire portfolio, right? Now, good range is again 1 point above 1.1, above 1 is acceptable, above 2 is good, above 3 is excellent. Usually, Sortino is higher than Sharpe for a good strategy. Now, this is the return segmentation, downside and upside, penalized and ignored by Sortino. Now, talking about Kalmar ratio, a risk adjusted measure evaluating the return relative to the maximum drawdown over a period. Usually 3 years, but you can change it as well. The formula is Kalmar ratio is equal to annualized return divided by maximum drawdown absolute. All right. Good range is above 20, above 1 is good, above 3 is excellent. Less than 1 implies peak to trough losses often exceed the annual gains. Now, this is the Kalmar components. Now, let's talk about trainer ratio. Measure returns earned in excess of that which could have been earned on a riskless investment per each unit of market risk, that is beta. Now, in this, we are not dividing it by standard deviation of the portfolio or standard deviation of the downside volatility, but the beta. Higher is better. Simple. It's better. It's best used to rank portfolio within a broader diversified portfolio. Let's talk about information ratio. Measures portfolio returns beyond the returns of a benchmark divided by the tracking error volatility of those excess returns. Formula IR RP minus RF divided by tracking error. Good range, very good range, outstanding. And this is the rolling excess return versus the benchmark. Now, let's talk about the drawdown matrix. The maximum drawdown is the maximum loss observed from the peak. So let's say this is the peak. Your strategy hit this peak and it fell down, right? And before this trough is made, before a new peak is attained, the bottom is calculated as the maximum drawdown over a period of time. Indicator of downside risk over a specified period of time. Yes. So maximum drawdown is VT minus PT divided by PT minimum. Yeah. So where V coefficient T is portfolio value at T, P is the peak value before T. Less than minus 15% is excellent. Minus 15 to 25, minus 25% is acceptable. Minus 30% is difficult psychologically, because let's say you had compounded your money and then all of a sudden during a max drawdown period, 1/3 of your money is lost or 1/2 of your money is lost. It's an unbearable psychological pain, right? This is the underwater plot, portfolio drawdowns. Now, the average drawdown, the mean size of all historical drawdowns provide a sense of the typical pain investor goes through the strategy. 1 divided by n of drawdowns, summation DDI. Now, good range ideally close to 0%, should be significantly smaller than the maximum drawdown. Example, minus 2 to minus 5%. This is just basically what's the average average of all drawdowns that you had. Now, this is the distribution of time in drawdown. Now, drawdown duration. So it calculates from this peak what's the maximum days or weeks your portfolio was in a drawdown, and what the time it took to recover its previous peak right here. So also known as recovery time if it recovers. DD is T recovery minus T peak. Good range less than 180 days. Prolonged multi-year drawdowns are psychologically tough and often leads to investors abandoning the strategy. Now, trade level metrics, win rate. Very easy, the percentage of individual trades that result in a positive return. Now, depends of payoff ratio. A trend following strategy might have a 35 to 40% win rate. A mean reversion might have 60 to 70% win rate, but small wins. Trend following have huge wins. Now, average winning trade is the summation of returns divided by number of winning trades. The mean percentage return or dollar amount of all profitable trades. Average win should be significantly higher in absolute momentum than the average loss to cover losing time. Let's say, so I will give you an example. Your average win should look like, let's say, $10, whereas your average loss should look like $5-6. This is a good ratio. Now, average losing trade, the mean percentage return on dollar amount of all unprofitable trades. So all loss making trades, what was the average loss that you make? Good risk management ensures this stays low. This is the graph for this. Now, payoff ratio. It is also in retail terms considered as risk to reward ratio. The ratio of average winning trade to the absolute value of average losing trade, right? The formula is average win divided by average loss. Why do we use absolute? So that we don't get a negative payoff ratio, because absolute is a function that directly converts any negative value into a positive value. Now, good range is above 1. Trend following might have above 2 or 3. Now, profit factor. What is profit factor? The gross profit of all winning trades divided by the absolute gross loss of losing trades. Of one of the most common and robust trading metrics, profit factor. Above 1 means the strategy is profitable, because your gross profit and gross loss at 1 is almost equal. Above 1 is robust and very good. Above 2 is exceptional. This is the graph for that. Expectancy, again guys, you can refer to this entire Jupyter notebook when you are in the cohort. Now, the expectancy, the mathematical expectation of an average profit loss per trade. So it's like expected value. Remember something we talked about. Your expected value should always be positive, must be higher than 0. Higher is better. It provides the statistical edge per trade. It's basically how much you can expect to earn or lose per trade. So casinos, they always have the edge. So your expected value in almost all scenarios in a casino is negative. Now, statistical distribution metrics. The first being skewness. Measure the asymmetry of return distribution. Negative skew means there is a long tail of negative returns. Large occasional losses means bad risk management. Positive skew means large occasional gains, which likely highlights that your strategy is not very robust and is dependent on good outliers to make profit. Positive skewness is highly desired. Negative skewness means you risk a catastrophic blowout. This resembles like a Gaussian bell curve. Now, this is returns KDE and normal distribution. Now, let's talk about kurtosis. Measure the tailedness of the returns. High kurtosis means fat tail events. Fat tail events exist somewhere around here and here. So they are extreme events which are almost statistically impossible to happen. The probability of them happening is very low, but they might still happen, so we have to factor them in our models. So high kurtosis implies fat tails, meaning extreme events, both positive and negative, happen more frequently than a normal distribution would predict. This is the formula. Depends. Most financial series have excess kurtosis above 0. A lower kurtosis means fewer outlier days. This is the tail of the distribution. Now, let's discuss tail risk matrix. Value at risk. This means this is the estimate of maximum potential loss over a specific time frame at a specific confidence level, being 95 or 95%. Statistically, the fifth percentile of historical returns for that, for example, 95% value at risk, depends on risk tolerance. A 95% daily value at risk minus 2% means we are 95% confident the portfolio will not lose more than 2% in a single day. Now, this is again the distribution. Now let's talk about conditional value at risk or expected shortfall. Calculates the expected average loss given that the loss has exceeded the value at risk threshold. It captures the severity of tail events. Again, I talked about the tail events, right? In a distribution curve, the tail events are the extreme events. Captures the severity of tail events better than value at risk. Good range, smaller magnitude closer to zero is better if value at risk is -2% and conditional value at risk is -6. It means when a bad day hits, it hits very hard and it's very bad for your portfolio, right? Now, let's talk about the Ulcer Index. What's the Ulcer Index? It's a technical indicator measuring downside risk in terms of both depth and duration of price declines. The higher the value, the longer it takes to draw down and recover. All right. Now, the Ulcer Index formula is right there. Lower is better. Less than 5 for conservative, less than 15 for aggressive. It heavily penalizes deep and long drawdowns. Square drawdowns component of Ulcer Index. This is the graph for this. Now, let's talk about the final 2 to 3 metrics that we are left with. We will be covering more and more videos, but I don't want to make one video that's extremely long because I know the ADHD degenerates we might have in our cohort, and I want people to be engaged through the video and not have stupendously long videos in which they are bored and the person teaching is really monotonous, right? Let's make the best use of our time. Let's talk about rolling Sharpe ratio. The rolling Sharpe ratio is calculated over a rolling window, 6 month, 1 year, 2 year, 3 year. It highlights the stability of the strategy over time rather than just a statistical number. So the Sharpe ratio you calculate might be static. So at in 2026 you might have a Sharpe ratio of, let's say, 1.5. But that same strategy, if you check for rolling Sharpe ratio, it might have a Sharpe ratio of maybe less than 1 in 2025. So that's why it's very important. Consistently above 1, it's a good range. If the overall Sharpe is 1.5 but rolling Sharpe drops below 0 frequently, the strategy is highly regime dependent. Regime dependent in the sense that trending markets or mean reverting markets, sideways markets, right? Now this is the graph for this. Now let's talk about beta. Beta measures as strategy sensitivity relative to a benchmark. So let's say uh, the indexes, let's say S&P 500, they are considered as a beta of 1. All right. And a stock, if it has a beta more than 1, in that scenario, let's take an example of Tesla. S&P 500 has a beta of 1 and Tesla has a beta of 1.5. So every 1% upside or downside move in SP 500 will cause a expected 1.5% upside or downside move in Tesla. A beta of 0% implies completely uncorrelated return. Negative beta implies that if index is going up, the stock or the asset might be going down. Dependent on goal. This is completely subjective. Now, let's talk about what we all focus on, right? What the reason behind this cohort is: alpha, the active return of an investment compared to a suitable market index. It is the return generated strictly by the edge of the strategy, not market beta. So it focuses on the strategical edge. It's the return of the portfolio minus bracket open risk-free return plus beta into RB and R minus RF. So good range is above 0%. Positive alpha indicates that the strategy is making more money than buying and holding the market at same risk level. All right. Now this is the rolling Sharpe rolling window for alpha. Guys, that will be all for today. Thank you so much for joining in. I hope you're having a great time and learning and adding value to your life as well, going through the concepts and trying them out in your own models. Thank you so much for your time. TED out.